So I guess to start, so broadly, CBRE forecasts a softening U.S. economy in 2026, but you expect a meaningful rebound in commercial real estate investments. So what, or why do real estate fundamentals remain resilient in this economic environment?
Okay, number one, I think the GDP growth, what we are forecasting is around 2%. So it's aligned with the consensus, right? And
Mhm.
number two, the inflation is trending down. It's around 2.4 to 5%. That's our
Mhm.
current forecast, which is good. And then the third component is we are forecasting the interest rate cut twice through the course of 2026. So all of those three components will translate into occupiers continue to lease offices, lease
Mhm.
retail, lease industrial. Second one is the capital market has been relatively cautious because of a cost of finance, because of high 10-year treasury in 2025, because
Mhm.
we are thinking about the interest rate going to cut twice. So that's why we're expecting to see the investment activities to recover. And our forecast is very, I don't say it's aggressive, it's realistic. We are forecasting investment volume to increase by 16% in
Mhm.
2026, which is quite substantial compared to wow, normally we are always say lower double digits or high single digit, but this year we're pretty much confident and pretty much across all the segments we're going to see some double digit growth in terms of investment sales.
Interesting. So the report also notes that total returns in 2026 will be largely income driven rather than appreciation driven. So how should investors rethink underwriting and asset management in this cycle?
It's quite an interesting dynamics. I think this is something everyone is thinking about. Most of the total return is coming from so-called rental growth because the fundamental are recovering. I think that's become a consensus. Everyone is thinking that way now. And then you pick the prime market, you pick out the best asset classes, you get your returns. However, I think the smart investors now should thinking about the asset enhancement. Why? Because when we are looking at the US commercial real estate market, there's not much supply, right? The
Mhm.
occupiers always want to best quality buildings, but we only had a limited stock for the best quality buildings. When the quality of the best buildings are running out of space or charging the superior rent, they had to move it into the next tier of a product. But
Mhm.
the next tier of the product, the quality is not as good as the top quality product. So we are thinking about the smart investors are going to the next tier properties and then do the asset enhancement and to do that value add, better utilities, better workplaces, better, ESG sustainability, all those different features. So
Mhm.
therefore, they can command for higher rent. So that is quite a feature we do believe to see in 2026. And I give you a snippet because we are also doing the US 2026 investment intention survey. Surprise, surprise. That segment, value added strategy, particularly in offices, investors are willing to pay higher than the asking price. So what does
Mhm.
that mean? That means they know that effect will happen. They know they want to ahead of the curve. They know the asset enhancements is so important. It's just
Mhm.
fascinating to see that dynamics has changed and also going to change in 26.
Yeah, very interesting. So office remains one of the most polarized sectors. So what are the broad trends you're forecasting for 2026 in the office market? You mentioned a little bit already with, demand spilling into lower tier assets, but
Okay, so let me know. Actually, we are expecting to see and the demand pretty much remain relatively resilient. It's a
Mhm.
similar level what we are seeing in 2025. So leasing activity for 2026 as a whole is going to increase around 4 to 5%. Okay, and so that is a good sign. And this is also see that last year was the first year we saw no supply, demolishing, and that is a continue going to be a feature into 2026. So this year we are expecting to see few markets are bottoming out. You see, last year we saw that New York is booming, San Francisco is bottoming out, and this year we are expecting to see a few more gateway market to bottom out, such as Chicago, such as LA. We also see some pocket of markets in Boston and in DC shows resilience as well. So therefore, we are going to don't be surprised. We will see more of a positive news coming from the offices, and particularly in the traditional tier one gateway market.
So turning now to industrial, what is causing industrial rent growth to remain subdued in 2026, and how do you see that evolving over the course of the year?
For industrial market, I have to tell you, it, we were wrong in 2025. We were very conservative in terms of our leasing, and we were surprised by the demand from the occupiers, Matthew. I can tell you that. So therefore, Q4 leasing was a historical high to our surprise. And given the dynamics, given the reshoring activities, given the what occupiers are looking for, and we are expected to see the industrial leasing to increase by another 5%. Total leasing is going to continue to be up around 5%. And then that puts the total leasing volume to be a 1 billion square feet, which is surprising. Okay. The one thing I want you to know that historically in the renewals is only around quarter of total leasing is a renewals, but we are expecting to see around 35% of our leasing is coming from renewals. Okay, that's one. The second component was flight to quality continues. We are talking to the occupiers. We are advised to occupiers is a tenant favorite market for now because we do see the wave of supply coming to the market over the past 2 years, and the renewal is coming through the next 2 years. So therefore, it's the best time for the occupiers to actually secure the assets on a better terms. So that's what we are thinking. And then most of the demand, similar to 2026, 2025 is coming from 3PL. It's a third coming from 3PL. And in the old days, landlord doesn't want 3PL. 3PL on the shorter leases, smaller spaces, but now they want 3PL because the 3PL is a lot of retailers, wholesalers outsource 3PL. That's one. Second component, we are seeing some reshoring activities. So given the tariff impact, we do see some reshoring are coming to the US as well. And then the proportion was very small, but now we are seeing the incremental increases in terms of leasing shares from lots of reshoring activities. So overall, I think we continue to forecast the market is going to be relatively resilient. And for leasing perspective, rental is under pressure. It's because of demand supply dynamics and also the good product bifurcation, good quality, similar to office where outperform, where demand for higher rent, lower first generation. I think they are going to struggle to keep up with the demand for the occupier in terms of quality.
Got it. So the report also says that retail fundamentals remain relatively strong, but consumer spending is becoming more selective. So which retail formats or locations do you see as most insulated if the consumer weakens further in 2026?
I have to tell you, because I'm coming from Asia Pacific, sometimes I am very demanding for the retail spaces, to be frank, because our Asia Pacific retail dynamics is more fun, it's more vibrant. And then the US, when I'm in Dallas, I kind of feel like, oh, wish it could be more fun for retail. But nevertheless, in terms of the location-wise, city-wise, we do see the higher population growth and the higher income suburb across the US, pretty much is going to be outperformed because those high income suburb and high population growth does support the demand for the retail spaces. Okay. The second one is grocery anchor centers, neighborhood strip malls, it continue to outperform. So those what we are seeing is very, very important. Again, flight to quality is what retailers are looking for. I also want to point out when the office market recover, such as here in New York. So you can see those prime, centralized retail street is going to be highly in demand. So those locations will continue to grow. So therefore, if you're thinking about Boston, LA, Chicago, their core office is going to recover, bottom out. I think those locations, don't be surprised, we're going to see the stronger retail demand as well. So we watch it very closely with your office dynamics because it will have a positive impact on the retail.
Interesting. So moving now into data centers, which is obviously a hot topic. So data centers are continuing to set records, but power availability is becoming the primary constraint. So
Yes.
how will power and infrastructure challenges shape where and how data centers get built in 2026?
Well, it's quite interesting. So therefore, you can see some power, for those easy access to the power and also the price for the commodity price. It's easy access to power for those market, which in the middle of, I would say nowhere in a kind of mountain west state, they get a lot of traction because of the easy access to the power and also the power price is relatively lower. So that becomes front and center of everyone's mind. I think in the past, you can see people talking about I want to build 10 megawatts. I get a smaller scales. I get a little bit of a discount for occupiers, but not anymore. So what we are seeing now is all the developers, all the occupiers, they focus on two things. It's number one is the power cost. The cost of a power is number one. Number two, how can I finish my construction? So speed to delivery are the key components. As a result, because of those two, so we are seeing the state like Alabama, Mississippi, Louisiana, Georgia, Florida, those states become a primary focus for greenfield development. And then, the structural tailwind is still there. And I also give you the snippet as well. When we are looking at investment intention survey, we're going to launch later this month as well. By default, we're also thinking about the data center should be a top 3, top 4 by the investors here in the US. It's still going to file number 5 or number 6, but increasingly the investors say, okay, I want to invest in data center, really strong fundamental. But they're getting very worried about number one is pricing. It's getting very expensive. Number two is exactly what you said, access to power and the cost of a power and cost of construction. So therefore become very, very difficult to execute it if you don't have the skill.
Right.
It's an interesting market. I think it's definitely very structural tailwind is happening there. And so therefore, but getting the right into underwriting and the deal side and the right size selection could be a challenge.
Interesting. And you're projecting that average medical outpatient building rent growth will reach a record high this year. So what is driving that?
Okay, number one, lack of supply. The medical outpatient construction completion is in a historical low. There's no supply. And number two, the healthcare in the US pretty much shows you that AI adoption is very, very low. So therefore, there's no efficiencies there. So what do we believe? AI adoption, read the newspapers, is going to be accelerating. So therefore, they can enhance the volume management and then space utilization. And then the third one is all about the federal healthcare policy risk, right? So they are going to, including the One Beautiful Bill, they are going to have 1 trillion healthcare spending reduction. As a result, you can see outpatient spaces will increase, right? And so therefore, the outpatient space demand will increase to provide and the patient to seek for affordable spaces. And then I was very, very surprised because if you look at all the major markets globally, I always use the US compared for the other countries, the other cities, the major cities. And then you can see like London, like Singapore, like Tokyo, like Hong Kong, they do have a medical outpatient centers and in the office buildings, surprise, surprise. And then they do have a fantastic stable income. And for the investor point of view, the occupancy tend to be very, very high. I think given the demand supply situation here in the US, I do think this asset classes is going to be shine in the next few years because we mirror the global trend. I think US a little bit lagging behind.
Right. And across sectors, I mean, maybe except medical outpatient building, as you said, AI is showing up as both a demand driver and as an operational tool. So how should real estate owners separate short-term hype about AI from its long-term potential impacts?
It's a quite interesting question. I feel like we really need to, our real estate people really need to thinking about how can we design a flexible spaces in order to fit for the future need. Because as of now, I think the AI hype will create a demand for real estate. That's what we all loved it, enhance efficiencies. But the space requirement, and it's just so important. You need to thinking about what's your layout for your space to fit for the future, and are you having the right infrastructure in your building to fit for the future need for AI? And the third one is you talking about if we had the AI help, how many locations you need to be. So location decisions, building design is also important. I just feel like we are just in the early real estate a bit late. So we're in the early stage of adopting AI. I just feel like for the companies or occupier, they need to be very, very flexible. So thinking about the future need. The flexible require, the layout and the infrastructure.
Right.
People are very hyped on AI, I have to say. And for real estate space, for real estate sector, we like it because it creates a demand. But as an operator, the company, the developer, the landlord, they need to thinking about how can I accommodate for the future need. So this is something I think we still figure it out.
So if investors and real estate professionals take away just one strategic lesson from the 2026 outlook, what do you think it should be?
It's quite you mean for the investor point of view or from the occupier point of view? Investor, right?
I guess both. Like you can do one for each.
For occupier, I thinking about aware of your situation. You need to act early to secure the superior space. I think 2026 will be probably the final year the occupier will be able to negotiate the good terms for the good quality spaces. You need to act earlier, not to think about what if, okay? And then for the investors, there's a two component. We're talking about total return is going to driving largely from the income growth, NOI growth, right? So that is everyone talking about that. So I want to have a two components. Number one, some investors, they already entered the market in 2019 and 2020, particularly for the industrial spaces and for the multifamily spaces, because that's the, huge recovery. I think for those kind of investors, don't be greedy, and then particularly they will be able to sell some of the assets so they can realize a return. And then so they already meet the target returns, they got a good run, sell it. And then by using the realized return, another dry powder to invest into some other classes. And then for me, the stronger uptick is yes, New York, San Francisco has recovered for the offices. What is the next recovery market?
Mm.
Also ahead of the curve. We are making our heads up. I think Chicago, LA, Boston, are pretty much coming into that space. So that is something people need to be aware of. And also, as you say, asset management, asset enhancement is a continuous because the lack of supply will be a feature. So therefore, how can we make sure your building can continue to outperform? That's going to be superb. That's going to be super important.
Mm-hmm. Great. Well, those are all the questions that I wanted to ask you, but I'll open it up now if you have any final thoughts or insights or comments you want to share.
Uh, I have to say, hold on. Let me just open something. I did it yesterday. Hold on. I I want to open something. Your first question, talking about why we are talking a very strong. I think I'm talking about productivity again, and also I didn't mention it's a tax cut. I think here in the U.S., I think that one big beautiful bill, and then is going to, the tax cut is going to create a demand. Is going to give the consumer more confidence to spend money. So that's the tailwind what we are seeing in the U.S. economy.
Mm-hmm. Got it.
Okay. And the second component I really want to highlight here, I always use US equity market and use US REITs as an indicator to see how physical real estate is performing, but also
Mm-hmm.
look at relative pricing. And when I was compare the equity PE ratio versus our REIT PE ratio, Matthew, US REITs is on a historical cheap value.
Mm.
I think we did an analysis a few months ago, and then we showed to some media that it was so cheap. As a result, 2026 is a good time to enter the market. And we don't want to address the other sector might be overpriced. I don't care about that one, but in the relative terms, commercial real estate is so cheap from the pricing point of view, and the fundamental is on the way to recover. As a result, we do believe for 2026 it's going to be a good year for us.
Great.
That's it.
Great. Well, thanks so much for taking the time today. It was very interesting and helpful.
Thank you, Matthew. Thank you for having me here.